Welcome back to The Explainer, everyone. I am absolutely pumped you're here today because we're basically holding a high-stakes tactical briefing. Seriously, if you're prepping for that ACCA BT1 exam, you're going to want to consider this your ultimate survival guide. We're cutting out all the fluff today, and we're strictly covering one of the absolute most heavily tested and frankly most frequently misunderstood concepts in the whole syllabus: cash versus profit. We're going to lock down the exact logic you need to dodge those traps the examiner has waiting for you. So, get ready, get focused, and let's conquer this thing.
All right, profit on one side, cash on the other. Let's just immediately shatter the ultimate accounting myth right out of the gate. Profit and cash, they are absolutely not the same thing, period. End of story. You know, so many candidates walk into that exam room totally believing that if a business is showing this massive profit, its pockets must just be bursting with cash. And honestly, that assumption right there, that's exactly how you fail the question. We are drawing a thick, uncrossable line between these two concepts today.
Section 1. Accounting versus reality.
So think of profit as merely an accounting concept. It's really just an abstract number governed by these rules called accruals and matching. It's kind of like a purely theoretical calculation just sitting on a piece of paper. The matching principle basically dictates that we record revenue when it's earned, and then we match the expenses to it. To put that super simply, if you deliver a product to a client today, you record the profit today. And that's regardless of whether a single actual coin has changed hands. You've earned the right to that money, so the accounting system says, hey, great job, you made a profit. But listen, that profit is completely detached from the physical money in your pocket.
Now cash is the exact opposite. We are talking about actual money. It's the hard currency sitting in the bank, the physical notes in the register. It's blunt, it's simple, and it is reality. Imagine, say, a highly profitable tech startup. On paper, they're making millions, right? Because they've signed these massive contracts and delivered their software. But if their clients haven't actually paid them yet, they literally have zero cash. And what happens then? They go bankrupt. Because you can't pay your employees with profit. You can't pay your server and electricity bills with an accounting concept. You have to pay them with cash. If you can firmly separate this concept of profit from the hard reality of cash in your head right now, you are already halfway to acing this whole section of the BT1 paper.
Moving on to Section 2, the credit sale trap.
Okay, I want to pose this exact exam scenario directly to you exactly how you're going to see it on test day. How can a business magically show that it has earned a profit, but its bank balance hasn't gone up by a single penny? It totally sounds like a riddle, right? I mean, profit is earned, but there is absolutely no cash to show for it. How in the world does this happen?
A credit sale. Boom. That is the ultimate trap, and it's your golden answer. When you sell goods on credit, you are handing over the product to the customer today, but you're agreeing that they'll pay you in, let's say, 30 days. That timing? It's absolutely crucial. You've made the sale today, sure, but you are not going to see that money for another 30 days.
Let's break down exactly how this disconnect builds. Step 1, the sale is made on credit. Now, because of those accounting concepts we just talked about, accruals and matching, the exact second that sale is finalized, Step 2 triggers. Your profit immediately increases on the income statement. Technically, you've earned it. But look at Step 3. Cash is not received. You literally just have a promise from the customer to pay you later, a receivable. This right here, this creates a massive, gaping disconnect between your accounting records and physical reality. Your profit is soaring, but your cash is totally stagnant.
Section 3. Beating the exam.
Listen closely. You must never make these two common exam mistakes. Number 1, assuming profit equals cash. If you read a scenario and subconsciously make that link in your head, you're going to choose the wrong multiple choice option for sure. And number 2, ignoring timing differences. The entire credit sale trap relies 100% on a timing difference. You know, that gap between when the transaction actually happens and when the cash physically moves. Ignoring that timing difference is exactly how they get you to fail the question. So drill this direct scenario to answer mapping into your head right now. Treat this as an absolute, non-negotiable survival rule for the BT1 paper. If the exam scenario reads profit earned but no cash, your brain should immediately lock onto credit sale in the options. That is the exact mechanism separating the accounting figure from the physical money. Seriously, lock this into your memory right now. I honestly just want to drop the mic with this golden one-line summary straight out of your BT1 notes. Profit is accounting, cash is reality. You need to treat this as a strict, unforgettable mantra. Take a breath and just let that sink in for a second. Profit is accounting, cash is reality. When you're sitting in that exam hall and you're stressed and second-guessing yourself, repeat this line in your head. Profit is just the accounting story, cash is the hard, cold reality. So, I'm going to leave you with this final challenge. When the examiner sets the trap, and trust me, they absolutely will, are you going to let a simple timing difference cost you your score? Of course not. You are now totally immune to the cash versus profit illusion. But, it does beg a bigger question. If profit can be this deceptive, what other numbers on a company's financial statements are really just theoretical illusions waiting to trap you? Keep that in mind and go conquer that BT1 exam.